Hi, everybody. I'm Greg Nietzschen. I am the managing director of Ceniarth. I wanted to thank Tonic and the Catalytic Capital Consortium for putting together this educational series on catalytic capital. We think it's incredibly important for family offices and foundations to really get their heads around the important differences that exist in how impact investing capital is being deployed, not in an attempt to create kind of better or less than dynamics in the sector, but really so that new entrants can be well informed about the breadth of opportunity that exists, and so how you all can appropriately match the impact you want to achieve with risk and return objectives. We are the impact first single family office of Diane Eisenberg. We manage both Diane's personal assets as well as the assets of the Eisenberg Family Charitable Foundation. It gives us a lot of flexibility in terms of the capital we deploy. We've got a bunch of experience deploying both unrestricted dollars as well as our foundation's endowment and program-related investments, PRIs from the foundation. In total, we manage around $600 million. From day one, Diane has set our North Star mission, really, to deploy impact capital into marginalized places and to deploy that capital in a way that prioritizes impact. And Diane has been upfront and public and in her questioning about why many family offices and private foundations, even those that are in the impact space, continue to feel compelled to seek market rates of return when she would say maybe they don't need the money. And she's really driven us to be sincere and evidence-based in our pursuit of getting capital into challenging places. Back in 2018, Diane made a very public declaration that we would shift, all of our assets in this direction, and so that's really the journey that we've been on for the last 4 or 5 years. What does that look like in terms of portfolio allocation? Well, we do spread that across a variety of sectors. We tend to think about our portfolio broken down into things like microfinance or agriculture, community development, affordable housing, as opposed to a classic asset allocation model. But I think it's worth noting that if you were to look at our portfolio through the lens of a more classic allocation, that we'd be moving toward a pretty unusual allocation by standards of typical family offices or foundations. We are actively divesting from most of our public equity positions, though I expect us to retain 1 or 2 of those positions for liquidity or even almost nostalgic purposes. We do maintain some fixed income exposure. We've done some interesting things with community capital management to focus some of our bond purchases on persistent poverty county codes in the U.S. But in general, I think we feel like our public exposure is really difficult to define as impact first, and so we're really pulling down from those allocations to move into other asset classes. So in the long run, if you'd look at our portfolio, we're going to be very heavy on various forms of private credit funds, though those could take many flavors. Very heavy on direct lending, heavy on things like real estate in our affordable housing portfolio, and then some real asset exposure as well, things like renewables and other assets that have community impact. I'd also note that we hold fairly limited positions in venture capital or private equity, which in many ways is a bit of a stylistic and temperamental approach that we hold as an office. We really prefer to invest in assets and funds where we can model out cash flows as opposed to the kind of crossing our fingers and hoping for the best. But we acknowledge the importance of of those equity players actually in many of the industries where we lend. So it's certainly not a knock, not a knock on the equity market. So when we think about returns across our entire portfolio, we've really targeted in an inflation plus office expense target. That for us has meant really looking to generate between 3 to 5% annually. Obviously, with inflation as high as it is these days, we're not looking at that target. We're really looking to generate a kind of consistent 3 to 5% over the years. On our unrestricted assets, that has no impact, obviously, other than Diane's own preferences for how much money might be generated by personal assets. On our foundation endowment, given that we're distributing 5% annually via PRIs, that obviously has some impact on the long-term size of our foundation. Now, the thing that for us works kind of differently than traditional foundations is that because our distribution requirement is going out in the form of recoverable PRIs that are consistently recycling to us, our actual overall total assets that we have to deploy over time, so long as those PRIs are not experiencing significant loss, that asset base is actually modeled as growing slowly over time, even with a foundation endowment that's going to generate probably less than 5% annually. So finally, I guess I'll just touch on how we built the team to execute on all of this. I would say that much like we experimented with a bunch of impact investing modalities, we also experimented over the course of the last decade as an office with both in-house and outsourced models. And I would say that the outsourced model of working with impact advisors or wealth management firms is effective and increasingly effective, actually, if you're interested in doing that more conventional finance first impact stuff. I'd say in many ways it's been incredibly heartening to see how quickly the field has grown, how most major wealth management shops now have some impact capacity and can pretty easily put together a complete, I'd call responsible portfolio that has both public and private options. That said, once we were kind of all in on this idea of impact first, and in this realm of seeking to originate and execute on really innovative catalytic deals, the world of advisors that are assisting on these kinds of deals is just tiny. I mean, I could probably count it on one hand. So, and in many ways, I think our view is that this makes some sense at the moment because most of the demand from the investor side is for market rate options. So I think it does leave asset owners that are truly committed to going down this catalytic path with fewer outsourced options. And we recognized this pretty quickly early on and said, hey, we just need to build our own team to do this. And that's what we've done. We've got a team of 14 strong now, primarily based in London, and a predominantly female team, given that we are a female-founded firm with a very strong orientation toward gender lens investing. I'd end by saying that we love to share our work. We really hold it to be a core value to do so transparently. So anyone who is listening to this educational series, who is looking to deploy impact first capital at scale and wants to trade ideas on pipeline or learn more about how we built the office, we are always open to those kinds of conversations. So please get in touch.